Okay, hi everybody. It is June 11, 2019, 12:39 p.m. here in New York City, Eastern Standard Time, 12:39 p.m., almost 1 o'clock in the afternoon. Okay, here is my scalping strategy. Any chart, doesn't matter. They roughly move the same, generate the same kinds of patterns and rhythms, and the oscillators move the same. So once I find a chart with a setup, I confirm the setup, and then I go for the interpretation and the forecast. Here, the oscillators that I use are two settings on two MACDs, and awesome oscillator, but primarily I use the RSI and then the stochastics. So I have it in the order of importance. First, the RSI, then the stochastics, then the MACD, another MACD, and the awesome oscillator. The specific settings for them I'll list in the description. Okay, then I use the default setting of the Bollinger Bands, as you can see, and that's not one of the indicators that I mostly use. I leave it, I don't leave it. It's not that important, but it can be helpful. So as long as I don't find it distracting, as long as I don't find it as too much information on my charts, I'll leave it, because there tends to be too much information sometimes. I do use 3 MAs, the 50 and the 5 EMA and the 9 SMA. So then I use the Fibonacci retracement tool. And basically that's it. Well, also I consider the round numbers, round price numbers, and round time numbers. For this strategy, it's not necessary to square the charts. Okay, so how do I begin? Well, it could be a 5-minute chart, a 1-hour chart, a 4-hour chart, a daily chart. But this is scalping. And so I find that the 1-hour chart is very facilitating. Anything between a 10-minute and 2 hours is great. So a 10-minute chart and a 1-hour chart and a 2-hour chart are advisable. Those are the best. All right. So we have increments here. This is the Think or Swim chart platform. Think or Swim, also known as TOS. So I'll call it TOS for short. On the right margin over here, the numbers, the pips, we see they are listed in increments of 20 pips. So here you have 1.0700. Then you have 1.0720. Then 1.0740. So these are 20 pips from this number to this number. And I have the grid lines showing the price levels. So I can use a price level, the Fibonacci tools and the tools of the platform. Because it's important to consider structure sometimes and the price levels. And so instead of putting price levels on top of the automatic price levels, which are the round numbers, I prefer the round numbers. But I do always look back and consider structure, consider if there are data points that are on the same price level. So instead of plotting a price level tool, I'll just look with my eyes. And there is a price level, you see. There's significant points at this price level. But instead of putting that price level tool I'll just look at the round number and see that it's very similar. It's very close because the price levels are actually price zones. So I use that as my target sometimes. All right, so we have some MAs here, moving averages. We have the Bollinger Bands, which I call BBs. And then we have these oscillators. And I keep my eye open somewhat for if a harmonic pattern or a harmonic pattern wannabe seems to show up, such as maybe over here. Here we have a hypothetic X, hypothetic A, hypothetic B, hypothetic C, hypothetic D. Every time a harmonic pattern or harmonic pattern wannabe seems to show up, I do not go to the Fibonacci numbers to verify exactly whether this is a godly, a bad, or any other sort of pattern. Why? That's too much work. And that's only a part of the strategy that may or may not be included. So if this specific context here is not a valid harmonic pattern, it still works like one. Because look, you have X, A, B, C, D. You can anticipate price is going to go up using the oscillators as confirmation. How much it may go up, that's another consideration. We'll get into that later. But if there is no harmonic pattern or harmonic pattern wannabe, still my strategy will work, but I use this pattern if it shows up as a added strength, added confirmation that price will indeed go in this desired direction. So where do I really begin? Well, the RSI is the most important tool here. If I can use only one tool instead of all of these, I will eliminate all these oscillators except the RSI. I will keep only the RSI at setting 7. It could be 8, which is a fib number. 7 is not. I could use 14, but 14 is a bit too smooth for me. I like this dynamism. I like the added points because they give us more data to read. And data is everywhere. So if you smoothen out the RSI, you eliminate important data points. And having more data to be able to read and interpret is crucial. So I use 7. 8 would be also pretty good. The data points, again, are important. Data is everywhere, and data is very telling if one knows how to read and interpret. It helps in the forecast, and I'll show you why. Because our main, what we're really looking for is significant divergence or convergence. There has to be a discrepancy between the points on the chart and the points on the RSI. I'll mostly speak about the RSI, but I'll sometimes refer to the other oscillators. Secondly, as I said earlier, the stochastic is the second most important. Okay, so the divergence, convergence phenomenon, I call it discrepancy because that's really what it is. We simply want two data points that are pointed downward on the chart to show price action with a low and with a lower low. The more significant the difference, the better. At the same time, we want the RSI to show a low and a higher low. So this will be a bullish convergence. And again, we want the both these data points on the RSI to be in the oversold zone, which is under the green line here. If it isn't, it's still usable, but not as strong. We want an optimal trade setup. We want a reliable set of conditions. And the most reliable is when you have a higher low, right? Here you have a low on the RSI, and you want a higher low, which we have here. Ideally, we want both of these data points to be under the green line, but if we were to draw a trend line here, we want it to be slanted. We want it to be steep. We want it to be noticeable, significant. Like this. From here to here is fairly significant. Okay? If it were like this, it would still be viable and usable, but not as strong. It's not as strong a signal to the upside as is this. Same here. If this here you have a low and you have a lower low. This is significant. So this, with this, is a good signal to the upside, forecasting a move to the upside. So on every trade setup, when I am doing an assessment of a certain context and I'm interpreting, I don't draw the trend line. I just use my mind, because if I'm going to be drawing on in every instance, it's a waste of time and energy. If I can do this with my eyes, almost like by second nature, it's better for me. Because look at the harmonic pattern. If this is a valid harmonic pattern or not, doesn't matter. The thing is that the X, A, B, C, D idea seems to work even if it's not a valid, based on legitimated Fibonacci levels all throughout the points. But if I'm going to verify that it is indeed a valid one that is established, it's more time and energy checking for the Fibonacci numbers, drawing the harmonic pattern, whether with trend lines or other tools. It's too much work. If I can learn to do these things quickly without clicking and drawing the tools, well, then it's so much better for me. The more expert a person becomes, ideally, one wants to be able to look at a chart, make an assessment visually with your mind without clicking so much, without plotting too many tools, and say, this is going to go up, this is going to go down, and go for it. We want the whole thing to be second nature so that we could quickly make 1, 2, or 3 trades per day and move on. Do it with 1 hour with a limited amount of work and clicking. Okay, so first thing I look at is there a convergence? And there is. When there are data points behaving like this, we have a low and a lower low, and a low and a higher low, that's considered divergence. And if it's an uptrend and we have 2 data points, high and a higher high, and then on the RSI, a high and a lower high, that's considered divergence also. But they're not both divergence. They're divergence when the trend lines are moving away from each other, as in the case of a regular bearish reversal. But it's not divergence when it's looking at the lows and we're looking for these points to be closer. That's a convergence. So there's a convergence and there's a divergence, but most people, including educators, they call both events divergence. Divergence going down and divergence going up. But no, it's divergence going down, but it's divergence when it's convergence when it's going up, such as in this instance. So because we have the trend lines converging, we have these data points converging instead of diverging. So here we go. We have a low and a significant lower low. On the RSI, we have a low and a higher low that is significant, so we can expect price to go up like it did here. So we would enter somewhere around here, and then we'll take profit only about 20-ish pips, and I'll show in another instance why. Now let's move forward and go to another instance. I'm scrolling. Now, as I scroll, here's a channel I'm going to use later to show how to use it. But we're scrolling down here, bar per bar. We scroll one. This is back testing. Now, in real time, when we're going for a real live trade, we don't use this. We're using this only for back testing. So, as I am back testing way back now on the AUD NZD, I don't know what the future is going to do. I'm only looking per bar over here. So I see in this hour, obviously, price went up. You see the green bar. Green is up, red is down. So what's happening in the next bar? Red. So you see we have some consolidation. We have some flatness here and with some occasional dynamism. Okay, so as I'm looking at the price action here, I'm really looking at the RSI because the RSI tells the future, and that's my point in this whole strategy. The RSI tells the future if you know how to read it correctly. A lot of oscillators, a lot of tools, including moving averages, even though technically they're considered laggards because they're lagging behind the actual price action. The actual price action is keen, but when read correctly, then the tools become keen because they tell you what the price action is going to do. And that's the key to trading, being able to interpret formations of the candles, of the moving averages, of the Bollinger Bands, and of the oscillators. Being able to understand that these lines, these tools are telling us something. So as we learn how to read what they're saying, we're able to interpret what's going on and what's going to happen. We're able to forecast accurately when we learn how to interpret these squiggly lines and these erratic looking candles. All right, let's go to the next hour. What happened? Well, we see some dynamism here. It's not that flat anymore, but on the RSI, it is still somewhat flat. So if the price action on the RSI, the line on the RSI, is kind of flat. You see it's going up and down, up and down, up and down, but it's staying within the zone of not overbought and not oversold. It's still consolidating. Then it doesn't matter that the actual price action of the candles looks like it's not consolidating. It's beginning to show some movement, some dynamism, some volatility. So what does the next hour show us? The RSI is looking the same. The RSI is looking the same. Okay, so I am focusing on what the RSI, what the RSI is telling me more than on what the price action is telling me. That's a crucial point. What is the RSI telling me? It's more bearish than bullish. It's beginning to act a little oversold. But then it jumps right back up. A little bit oversold, a little bit overbought, coming back down. So there is movement. It's no longer consolidated. It's no longer acting volatile. It's no longer acting flat. It's beginning to show some volatility. So it's, beginning to generate interest. And here we have a crossover of the shorter MA over the longer. So that's a signal to the downside. More than likely, 10, 20 pips will be gained to the downside right here if I were to go in. And there you go. A few pips to the downside, right? But we're going to stick strictly to my strategy. And my strategy begins with looking for a bullish convergence by looking at the lower data points on the RSI and on the price action, or a bearish divergence signal while looking at the data points on the highs on the price and the highs on the RSI. And I haven't found anything significant yet. You see, we have two lows here, but they're not very discrepant. And then the two lows on the RSI in the same location, also, it's not very discrepant. It's too flat. And flatness is unpredictableness. Now it's very significant. I could draw a trend line right here. From here to here, this is a significantly lower low. But we don't know yet whether it's going to continue to go low or stop right there. All we know is that there's a significant bearish bias in this context over these 24 hours. So this being a 1 hour chart, that means that these lines, these vertical dashes are 24 hours apart. And then the grid lines are also 24 hours apart. The dots here, and here are showing 12 o'clock midnight to 12 o'clock midnight. The vertical dashes are showing 5 o'clock p.m. to 5 o'clock p.m. the next day, which is when the New York session closes. Okay, so we move forward 1 more hour. Now, since we are seeing a low and a lower low over here on the RSI in the same location, we're not seeing a higher low, which would be a significant signal of a upcoming bullish reversal. We're seeing instead a lower low. We're seeing a lower low on the price action, and we're seeing a lower low on the RSI, indicating that price is going to continue going lower. How much? We don't know, and it's not our concern. However, if we begin to look at the other oscillators, such as the MACD, we see that the histogram on it is beginning to turn dull, which is the beginning of revealing that the strength to the downside is waning. So price can very shortly begin to go up. But that's not set in stone, because this is very fickle and volatile and unpredictable, unreliable. So we need a lot of signals to say the same thing. That's why we have a lot of signalers. We have a lot of indicators. We want as many as possible to all indicate the same thing. Right now, we're getting more signals to the downside than to the upside. The RSI, the stochastics, this MACD, this awesome oscillator, these two MAs, and the actual candles. Everything seems to be saying bearish, bearish, bearish. So we move to the next and the next. Now we have a move to the upside. Nothing significant yet. We don't have a signal to the upside. It's probably going to go up. If a person wanted to guess, yes, it's more likely that price is going to begin to go up now, the next hour or two or more. Sure, a bearish sentiment is probably right upon us. We have a formation of this candle here, which is the green candle here, is telling us price is strong to the upside now, but it's not enough for us to go on yet. But it's getting there because look, the RSI is beginning to point upward at the same time that the stochastics is, this MACD and this MACD. The awesome is the least of the strong indicators in this collection. So if I were going to take a trade now, I'd say let's go up. More than likely, of course, it's going to go up a bit. Well, it turned flat on me, see? And it went further down. Okay, so because this strong candle went up and closed right here, and the indicators were indicating continuation to the upside, but it went down instead, it only gave us 3, 4, maybe 5 pips tops. And it took several hours to give us that. That's why it was an unreliable signal. And the confirmation that it was an unreliable signal is that this continued downward strongly. So that's a trade that we should not have taken. We should not have taken that. But if we did, we would have gained 5 pips. And let's not even talk about stop loss because we're not using stop loss in my strategy. All right, now let's see what else price did. Now we still have a low on the price action here and a significantly lower low here. And RSI is also signaling a move to the upside. Here we have a low and higher low, but this data point is not significant. The discrepancy is not significant, even though the oscillators are indicating a turn to the upside. So again, we'll get a few pips to the upside, but we don't have a strong signal. Even though at this point, at this very hour, we do have, okay, yeah, this does look like a nice signal to the upside. So what we would do then is take the Fibonacci retracement tool and put the first point here and the second point here. Now, right now, I still don't know what's going to happen because I have not seen this yet. I don't know the future yet. But based on what I'm seeing here now, okay, so if this were real time and I see that this is a low, this is the high, this is a low, this is a swing, and there is going to be a movement to the upside because we have the orange line on this MACD setting popping out of this gray histogram, and that's one of our signals of a reversal. And we have the crossover on this MACD setting and the histogram turning gray, so or dullish. That's a signal to the upside. The stochastic is crossing over and getting ready to jump out of the oversold zone and back into an upward bias. The RSI also pointing up, and the blue on the awesome oscillator is also a signal to the upside. So we have 5 oscillators all telling us something going to happen to the upside. And we have two green candles saying we're going up. And we have the shorter MA crossing over the longer MA here, the blue crossing up over the orange. So what do? Well, we can take a position right now at 1.0654. We're going to go long. We're buying. What is our target? Well, usually on a healthy swing like here from this high to this low, our first target, which is TP1, is the fib number 38.2. TP2, or take profit 2, which is a target. Take profit means target. Same thing. So TP, take profit target 1 is 38.2 and TP2 is 61.8. So what I did is, if I know that the price action wants to hit at least the first target, which is 38.2. But sometimes the strength to the downside is such that no matter how hard price may try to hit that first target, it doesn't get there. Sometimes it comes a little short of it. So let me draw this green line here, which will help us see. This is target 1, 38.2. However, if price goes up to that target but doesn't hit it, it'll come really close to it. So instead of going for the exact 38.2 as a target, I go a little short of it, maybe 5-ish pips short of it, and I'll make this my target. So like I was saying, sometimes the price sentiment is to the downside, but it's going to try as much as it can to hit the target 1, TP1. If it doesn't hit it, it'll hit the zone. But sometimes the strength to the downside is such that price cannot even approach the 38.2. So what it'll do is it'll go to the previous strong Fibonacci level that can be considered a target. So if this is our target 1, I call this the 23.6 a pre-TP1. So we have a pre-TP1, then we have TP1. Then we have the 50%, which I call pre-TP2, and 61.8, which is the golden ratio. That's the legitimate, valid, well-established TP2, or our target 2. So on a swing like this, our target 1, TP1, is 38.2, but I create the pre-TP1, which is 23.6. We have an established 61.8 as the TP2. I said, but in case price doesn't go there, but it goes past TP1, it'll go to pre-TP2, which is 50%, the 50% price level from the based on this swing. And if price doesn't go to pre-TP2, it'll come close to it, because our targets, whether they're pre-TP1 or TP1 or pre-TP2 or TP2, they're not exact specific price levels, they are price zones. So we got to be conservative, because if price hits our target but not exactly, it'll come close to it and we can make profit. But if we make our target the exact fib number, we may be disappointed, because price has a tendency to come just 1 or 2 or 3